Have you ever watched the stock market crash and wondered why Warren Buffett seems almost happy about it? While your neighbor is panic selling everything, while financial news is blasting doom and gloom, the ultra-wealthy are quietly doing something that makes no sense. They're buying. They're celebrating. They're actually excited. Here at Simple Money, I've spent years studying how the wealthy think about money differently than everyone else. And what I'm about to share with you might completely change how you see market crashes forever. Because here's the uncomfortable truth. The stock market going down isn't actually bad for building wealth. It's one of the best things that can happen to you, but only if you understand why. Let me explain. Here's what's really happening when the market crashes. Everyone sees the same numbers. The Dow is down 2,000 points. Your portfolio just lost 15% in a week. The headlines are screaming about recession and catastrophe. But wealthy investors are seeing something completely different. They're not looking at what they lost. They're looking at what just went on sale. Think about it this way. Imagine you walk into your favorite store and everything is suddenly 50% off. Would you run out screaming? Would you panic and refuse to shop there anymore? Of course not. You'd probably buy more than usual because everything's cheaper. But when stocks go on sale, most people do the exact opposite. They sell. They panic. They swear they'll never invest again. This isn't because people are stupid. It's because our brains are wired completely wrong for investing. And understanding this wiring is the key to everything. So let me break down the 5 reasons why the ultra-wealthy actually celebrate market crashes. And more importantly, how you can start thinking the same way. The first reason is what I call the accumulation advantage. Here's what most people don't realize. If you're still working and still investing, a market crash is the best thing that could happen to your retirement account. Let me show you why with some real numbers. Let's say you invest $500 every month into the stock market. When prices are high, that $500 buys you fewer shares. Maybe 10 shares. But when the market crashes and prices drop by 30%, that same $500 now buys you 14 shares. You didn't invest more money. You just got more ownership for the same price. Now here's where it gets interesting. When the market eventually recovers, and it always has throughout history, you now own those extra shares. Those shares you bought at discount prices during the crash are worth just as much as the shares you bought at full price before the crash. This is why Warren Buffett says he hopes for a market crash every year he's still accumulating wealth. But most people miss this completely. They see their account balance go down and they stop investing. Or worse, they sell. They're so focused on the temporary paper loss that they miss the incredible opportunity sitting right in front of them. Think about this. If you're 30 years old and planning to retire at 65, you have 35 years of investing ahead of you. A market crash today means you get to buy at discount prices for months or even years. When you retire 3 decades from now, those discounted shares will have had 35 years to grow. The math is simple but powerful. More shares at lower prices equals more wealth in the future. The people who build serious wealth understand this deeply. They don't fear the crash. They fear missing the opportunity to buy during the crash. The second reason is what I call the emotional arbitrage. Here's something that might blow your mind. The stock market isn't actually that complicated, but human psychology is incredibly complicated, and the gap between these two things creates massive opportunity. Let me explain what I mean. When the market crashes, nothing fundamental changes about great companies overnight. Apple didn't suddenly forget how to make iPhones. Microsoft didn't lose all its customers. Amazon's entire business model didn't disappear. But the price of these companies drops dramatically. Why? Because of emotion, fear, panic, uncertainty. This creates what wealthy investors call emotional arbitrage. They're essentially buying assets from panicked sellers at prices that don't reflect the actual value of the business. Think about it like this. Imagine you own a rental property that generates $2,000 a month in rent. One day, your neighbor panics about the economy and offers to sell you his identical rental property for half of what it's worth. Would you take that deal? Of course you would. That's exactly what happens in the stock market during crashes. People are selling shares of profitable companies at panic prices, and wealthy investors are quietly buying them up. Here's what makes this even more powerful. The wealthy aren't smarter than everyone else. They're not better at predicting the future. They just understand that emotional decisions create opportunities. When everyone else is terrified, that's when assets go on sale. When everyone else is greedy and excited, that's when assets are overpriced. This is why you hear that famous saying, "Be fearful when others are greedy, and greedy when others are fearful." But here's the thing. Knowing this intellectually and actually doing it emotionally are two completely different things. The wealthy have trained themselves to see opportunity where others see disaster. They've programmed their brains to get excited when they should feel scared. The third reason is the velocity effect. This one's particularly powerful, and most people never think about it. During normal times when the market is steady, your money grows slowly and predictably, maybe 8 to 10% per year on average. But during crashes and recoveries, something magical happens. The velocity of wealth creation accelerates dramatically. Let me show you what I mean with a real scenario. Imagine the market drops 30% over 6 months. If you kept investing during that entire drop, you bought shares at progressively lower prices. You got more and more ownership for your money. Then the market recovers over the next year or two. All those shares you bought at discount prices are now rising in value simultaneously. Your wealth isn't just growing, it's growing faster than it would have during normal times. This is the velocity effect. Crashes followed by recoveries create faster wealth accumulation than steady markets. Here's why this matters so much. Wealth isn't built in straight lines, it's built in bursts. The people who have money available and the courage to invest during crashes experience these bursts. The people who panic and sit on the sidelines miss them entirely. Think about every major market recovery in history. After the 2008 financial crisis, the market didn't just recover, it roared back. People who bought near the bottom experienced some of the fastest wealth creation in modern history. After the March 2020 crash during early COVID, the market recovered so fast that investors who bought during the panic made years' worth of gains in just months. The ultra-wealthy don't just survive crashes. They use crashes to accelerate their wealth building. They understand that volatility isn't the enemy, it's the opportunity. The fourth reason is what I call the selection filter. Here's something nobody talks about. Market crashes reveal which companies are actually strong and which ones were just riding the wave. During good times, almost every company looks successful. Even mediocre businesses with okay products can thrive when the economy is booming and money is flowing everywhere. But during crashes, the truth comes out. Weak companies with too much debt fail. Companies with bad business models get exposed. Companies that were overvalued crash back to earth. This is actually incredibly valuable information for investors. The crash does the work of separating the strong from the weak. Wealthy investors love this. They watch carefully during crashes to see which companies maintain their fundamentals. Which ones keep generating profits even during tough times? Which management teams make smart decisions under pressure? Then they buy those companies at discount prices. Think about it like this. Imagine you're shopping for a used car. Wouldn't you want to see how that car performs during a harsh winter or a rough road trip? The crash is the harsh winter for companies. It reveals what's really under the hood. This is why legendary investors like Warren Buffett often wait for crashes to make their biggest investments. They're not trying to catch a falling knife. They're waiting for the market to reveal which companies are truly excellent. Then they buy those excellent companies at crisis prices. The selection filter turns market crashes from scary events into valuable screening tools. The fifth reason might be the most important of all. I call it the mindset moat. Here's what's really happening beneath all of this. Every market crash creates a psychological divide between two types of people. There are people who panic, sell, and swear off investing forever. They see the crash as proof that investing is too risky, too scary, too unpredictable. They retreat to cash or overly conservative investments that barely keep up with inflation. Then there are people who stay calm, keep investing, and even get excited about the opportunities. They see the crash as a temporary discount on future wealth. Over time, this psychological divide becomes a wealth divide. The people who can handle market volatility build serious wealth. The people who can't handle volatility stay stuck. This creates what I call the mindset moat. It's a protective barrier around wealth building that most people can never cross because they can't overcome their emotional reactions to market crashes. The ultra-wealthy don't have a secret investment strategy. They don't have access to special information. They just have a different relationship with volatility and fear. They've trained themselves to see crashes as opportunities instead of threats. and this psychological edge compounds over decades into massive wealth differences. Here's the uncomfortable truth. The reason market crashes transfer wealth from the middle class to the wealthy isn't because of some conspiracy, it's because of psychology. When middle-class investors panic and sell, wealthy investors calmly buy. It's a voluntary transfer of wealth driven entirely by emotional reactions. The mindset mode is the difference between people who build lasting wealth and people who stay stuck forever. Now, let me tell you about two people who experienced the exact same market crash completely differently. Their stories reveal everything about how mindset shapes financial outcomes. Meet Sarah. She's 32 years old, works in marketing, and has been diligently investing in her 401k for 5 years. She's done everything right. She contributes 10% of her salary. She's diversified across index funds. She barely even looks at her account most of the time. Then the market crashes. 15% down in 2 weeks. Sarah logs into her account and sees that she's lost almost $8,000. $8,000 that took her months to save and invest. Gone. She can't stop thinking about it. She checks her account every day, watching the number drop lower and lower. She reads the news headlines talking about recession and layoffs and chaos. Her coworkers are panicking. Her dad calls and tells her to sell everything before she loses more. Sarah stops contributing to her 401k. She tells herself she'll start again when things stabilize, when the market recovers, when it's safe again. She doesn't sell everything, but she definitely stops buying. She can't stomach the idea of watching more of her money disappear. 2 years later, the market has fully recovered and gone even higher. Sarah's account is worth more than it was before the crash. But here's what she doesn't realize. If she had kept contributing during those 2 years, especially during the lowest points of the crash, she would have bought shares at incredible prices. She would be tens of thousands of dollars wealthier than she is now. Sarah missed the opportunity because she was too focused on the temporary pain. She reacted emotionally instead of strategically. Now meet Marcus. He's 33 years old, works in software, and has been investing for about 6 years. He's not wealthy. He's not a financial genius. But he's read a few books about long-term investing and understands the basic psychology. When the same market crash hits, Marcus also sees his account drop. He's lost almost $10,000 on paper, but Marcus has a completely different reaction. He thinks to himself, shares are on sale. This is exactly what Buffett talks about. Everything I want to own just got cheaper. Marcus doesn't stop investing. He actually looks at his budget to see if he can temporarily invest more. He increases his 401k contribution from 10% to 15% for the next year. He takes some money he was saving for a new car and invests it instead. Is Marcus scared? Yeah, a little. But he's more excited than scared. He understands that he's not retiring for 30 years. What matters isn't the price today. What matters is how many shares he owns 30 years from now. Marcus keeps investing through the entire crash. When prices hit their lowest point, he's buying the most shares he's ever bought with each paycheck. He's accumulating ownership in great companies at bargain prices. 2 years later, when the market recovers, Marcus isn't just back to even, he's massively ahead. Those shares he bought during the crash have recovered fully, but he owns way more of them than he would have if the crash had never happened. By the time Marcus retires, that single decision to embrace the crash instead of fear it will be worth hundreds of thousands of dollars in extra wealth. Here's what most people don't realize about these two stories. Sarah and Marcus had the same opportunities. They experienced the same market crash. They had similar jobs and similar incomes. The difference wasn't luck. The difference wasn't intelligence. The difference wasn't access to better investments or secret information. The difference was entirely psychological. It was about how they interpreted the same situation. Sarah saw danger. Marcus saw opportunity. Sarah focused on temporary losses. Marcus focused on long-term accumulation. This is what I mean when I say the ultra-wealthy celebrate crashes. It's not because they're happy about losing money. Nobody likes seeing their account balance drop. But they've trained themselves to look past the temporary discomfort and see the strategic opportunity. They understand something fundamental about wealth building that most people never learn. Volatility is not the enemy. Volatility is the mechanism that creates opportunity. Think about it this way. If the stock market went up in a perfectly straight line forever, there would never be any opportunity to buy at discount prices. The only time you can get assets on sale is during the chaos and fear of a crash. This is why wealthy investors actually hope for crashes while they're still accumulating wealth. It's counterintuitive, but it's mathematically true. More volatility during your accumulation years means more wealth at retirement. The challenge isn't intellectual. Most people can understand this logic. The challenge is emotional. Can you train yourself to stay calm when everyone around you is panicking? Can you force yourself to buy when every instinct is telling you to run? This is the mindset mode in action. It's not about being smarter. It's about being psychologically stronger. It's about seeing what others can't see because they're too overwhelmed by emotion. Here's the really important part. This isn't about timing the market perfectly. You don't need to buy at the exact bottom of every crash. You don't need to predict when crashes will happen. You just need to keep investing consistently through crashes instead of stopping. You just need to resist the urge to panic sell. You just need to see crashes as opportunities instead of catastrophes. That simple mindset shift, repeated over decades, creates enormous wealth differences. It's the difference between retiring comfortable and retiring wealthy, between having enough and having abundance. The ultra-wealthy understand this in their bones. They've internalized it so deeply that their default reaction to market crashes is excitement rather than fear. They've built the mindset moat so strong that volatility can't shake them. And here's the beautiful part. This isn't something you're born with. It's not genetic. It's not about your personality type or your risk tolerance. It's trainable. It's learnable. It's a skill you can develop. You develop it by understanding the math behind long-term investing, by studying market history and seeing that crashes always recover, by reframing volatility from danger to opportunity, by focusing on accumulation instead of account balances. Every crash you live through and don't panic during makes you psychologically stronger for the next one. Every time you keep investing when you're scared, you're building your mindset moat a little higher. Every time you see prices drop and think, "That's a sale," you're thinking like the wealthy. So here's what it all comes down to. The accumulation advantage, the emotional arbitrage, the velocity effect, the selection filter, the mindset moat. These aren't random advantages. They're all connected by one central truth. Market crashes don't destroy wealth. They transfer it from the panicked to the patient, from the emotional to the strategic, from people who see danger to people who see opportunity. And the beautiful thing? You get to choose which side you're on. Not by having more money, not by being smarter or luckier, but by choosing how you interpret and respond to volatility. The next time the market crashes, and it will crash again, you'll have a choice. You can panic like Sarah, or you can stay calm like Marcus. You can see losses, or you can see sales. You can retreat, or you can advance. The ultra-wealthy aren't celebrating your losses during crashes. They're celebrating the opportunity that fear creates. They're celebrating the chance to buy great assets at discount prices. They're celebrating another cycle that will separate the psychologically strong from the psychologically weak. The question isn't whether you'll experience market crashes. You will. The question is whether you'll let those crashes break you or make you wealthier. Whether you'll see them as disasters or as opportunities. That choice will determine more about your financial future than almost any other decision you make.